everyone, and welcome to our special episode of Fundamentals. Our guest today is Raunak Onkar, Fund Manager and Head of Research at Parag Parikh Mutual Fund. He's the co-fund manager of Parag Parikh Flexi Cap Fund. In a world chasing noise and narratives, this episode is a deep dive into the core principles behind the particular fund. From its global approach to its valuation driven philosophy and the discipline that defines every investment decision. Thank you, Ronak, for talking to us today.
Thank you, Megha, Harsh, and the ZWest team. Thank you for inviting me.
First of all, many congratulations for being one of the largest flexicap funds in the industry. It is no ordinary feat with the way you have managed the fund, delivered returns, and managed risk, so to say. Uh, I think it commands the respect in the industry for being one of the most actively managed funds in the flexicap category. I would like to understand from you, Ronak, what is the core philosophy with which you have been managing this fund, which has led to such stellar returns?
Thank you, Megha, for the accolades. And of course, it's a team effort, and we have had fantastic leadership right since Parag Bhai used to be there. The foundations were quite strong in terms of how we wanted to manage our products. And Rajiv has had a great years of experience behind of him, and he's provided a lot of foundational understanding and support, and even innovation in terms of how the scheme has to be run. So it's of course we are working on the foundation set by uh, uh, our founders and the fund managers earlier for us. So the principles at which PPFAS Flexi Cap Fund is managed, mostly it's a value investing approach. If you go back even as far back as our initial communication, there were three, four fundamental things that we wanted to communicate to investors. One was the product equity as a asset class, or a product that we are trying to launch is a product which is suited for investors who have a longer term time horizon, because equity is not something you can invest and trade out of as and when you feel like it. It is supposed to be a planned approach, and you have to make sure that equity as asset class becomes part of your portfolio, and not just equity just because you have to invest in equity. So a longer term approach was warranted. Second is the kind of investments we wanted to pursue should be globally diversified. That was an initial important step that we took, that it's not necessary that the ideas that you find should be only in the country that you operate from. The ideas can be anywhere, good ideas can be anywhere, good value picks can come from any geography. So that is one approach that we chose. Third approach is about the selection of the investments that we would make. That is the kind of quality of companies we want to invest in, the kind of quality of managements or promoters we want to partner with when we invest for the long term. That was very, very clear in our minds. And lastly, not to chase any of the fads, fancies, or not to chase momentum of any idea or a sector just because everybody else is wanting to invest in it. So be very, very conscious about the price. So number one was equity for the long term. Number two was to make sure it's diversified. Number three, very, very carefully select the quality of people and the quality of businesses we invest in. And number four is to pay a reasonable price for partnering in the opportunity. So these are the core principles that we followed right since day one. And even before that, we used to run the PMS with the same approach. And even before the PMS, I was told, and even from the older reports that we have seen from that time, when it was a broking house, PPA was a broking house. Even the long-term orientation was, I think, the fundamental thing that drove us even since that time.
As they say, even if we make, short-term mistakes, but if the horizon is long-term, a lot of it can be kind of taken care of. And I think it is also very reflective in the way you have also kept your exit loads, which are, I think you would be, if I'm not wrong, the only fund who has a exit load for 2 years. So that kind of also sets you apart in the many other ways, how you distinguish yourselves. So, as you alluded to, you have not just restricted yourself to domestic equities. Today, even as we speak, you hold close to about 11% international exposure. So, Ronak, I would like to understand from you what role does global allocation play in your portfolio construction? And do you find any advantages in terms of quality of disclosures, governance, or the quality of ideas, innovation, etc., when you're kind of looking at these companies?
So, in short, all of the above, but let me give you a description of why
Yes.
we chose this approach. So, firstly, what we see today as an 11% of the portfolio was at its peak about 30%. And just to make your listeners aware that this is not by design that it has become 11%, it is actually because of regulation. RBI has come up with a restriction on the entire AMC industry in Feb 2022, that they cannot invest or repatriate more money abroad to invest in foreign securities. So whatever investments we have made till that time, we are allowed to retain them, and whatever dividends that we receive from those investments, we can reinvest them, or even within that portfolio, we can shuffle those investments, but no new money can go. So from Feb 2022, most of the incremental or all of the incremental money that has been as an inflow of the PPFAS Flexi Cap scheme has gone into domestic stocks. And whatever portfolio has been there has naturally shrunk from 30% to now 11%, as the domestic markets have also done well, inflows have also come in. But interestingly, even those stocks, international stocks, have also done all right. So they've retained at least 11% of the value. The question that you asked is very important. And what does international allocation in the portfolio do for an investor? So, if you look at the beginning of how we started investing, we wanted to keep a third of the fund in global allocation. Is because one of the most important things we saw over time, if you just look at global markets versus emerging markets, developed markets and emerging markets, there is no clear winner consistently over a long period of time. So at some points in time, your international markets do well. At some points in time, domestic markets do well. So how do you capture the winners across both of these cycles if you have a chance to invest in them? So one way to diversify is to do global allocation. And it so happened that the Flexi Cap Fund was allowed to invest in global stocks to the extent of up to 35%. And that's a initial advantage that we chose to have in the product as a differentiation from most of the other AMCs at that time. Secondly, the kind of businesses we get to invest in our domestic market are very, very different from what is available globally. To give you an example, we are using a software which is made by an American company for this video conferencing. Most of our technology we are using today, our laptops, computers, smartphones, most of the things are brands which are foreign brands. They're not local brands from India. And this is again by structural design. It's not something that we have chosen to happen, but it just happened that way. So when we kind of have these kind of advantages in the companies that operate outside and the products that we are using, why just be consumers? Why not be also investors in the growth trends of all these companies? So there is no Google equivalent from India, which is listed in India. There is no Amazon equivalent of India. There is no Meta platform or Facebook equivalent in India. There's no Microsoft in India, unfortunately. So if you want to participate in the growth trajectories of those businesses, it is useful to have a portion of your portfolio dedicated to those unique opportunities which are not available in our domestic market. Another interesting thing was, if you look at the kind of diversification need that we have. So, something that happens in domestic borders in our country, like a war situation can arise with our neighbors, or we can have a demonetization like event, or we can have an ILFS crisis. So, a lot of these local crises that happen in our country affect our market or our short term market performance, but they have no bearing with what happens globally. Most of the times these events don't impact the global stocks values, so that also creates some sort of a lower volatility of our NAV. We have noticed that in the past. Another very, very important aspect we saw was, many companies have their parent companies globally listed, whereas their domestic subsidiaries are listed in our country. For example, Nestle or 3M. These kind of businesses have a very local focus and a local revenue stream and local cash flow from only domestic operations, whereas the parents have a global operational base, and they have a global cash flow earning, and they have a different capital allocation philosophy as well. So if you look at the valuations, even today, the valuations of the global parents compared to the valuations of domestic subsidiaries of these MNCs, you will see a stark difference in the valuations despite having a smaller piece of the global operations. And in many times, if you just average out or normalize the growth rate for, say, 3 year or 5 year period, you will see similar growth rates across both of these companies. So it was also evident that you can actually pay a lot less to participate in the same opportunity, but a better opportunity by investing in the parent company of a domestic listed AMC, MNC. So all of these advantages accrue when you come to you when you decide to invest globally, and that creates a good diversification, and it disconnects you a little bit from the volatility of the domestic prices.
It actually offers the truest diversification because a lot of Indian companies will be kind of affected by the same macro factors in India. So another important distinction that we have, kind of seen in your fund has been the cash holding. You have never shied away from holding very high cash levels, irrespective, of what your peers are doing. I'd like to understand, how do you think about cash? Is it, a byproduct of discipline or a tactical asset allocation approach, or is it attributed to the flows you get into the fund? Because in how difficult it is to kind of convince investors, especially in an euphoric market like what we are witnessing at this point in time.
So, point I mentioned earlier about the principles we follow while investing is to not chase valuation, not to chase fad or fancy, and that applies here as well. So, when you're building a portfolio of stocks, we have a screening of almost 500, 600 companies across the world. A bulk of them are domestic companies, and within our research team, our job is to make sure that we are on top of the entire tracking universe that we have, and within that whatever ideas we find are reasonably valued, have growth expectations aligned with what these sectors are doing globally as well as domestically. If we find something as reasonably priced, if the management meets our criteria of quality, that also we consider while investing. And at the same time, if they're reasonably priced, they get an allocation in the portfolio. So the entire process is fully bottom up. So there is no macro decision while managing the fund that we have to keep certain amount of money in cash at all times. That is not the case. In fact, there are moments in the past in the fund that we have 0% allocation in cash when the valuations were extremely attractive. So cash, then it becomes a residual value of all the things you mentioned. One is the inflows that we get through SIPs, lump sum investments, or something that has become overvalued, we have sold in the portfolio, or we have found something which is a good replacement for something, but the valuation is not there at the moment. So we can wait. And this waiting also is not free of cost. We actually get the money market returns for waiting. So if you're getting money market returns for waiting, and you are okay to look like a fool for a while when the market goes up and you're not participating in that rally to the extent of the cash you hold, I think it's okay because you still have a bulk of your portfolio invested in the ideas that you believe in and are not too expensive. But the remaining part of the portfolio will be deployed when we find good opportunities to invest in. So we are no, we're not obliged to chase any ideas just because we have cash. And when we communicated to our investors right since the beginning, we have told that we are not forced to invest. We will invest to the extent that the scheme allows us to invest. And whenever we get an opportunity, we will deploy very, very aggressively. So, to give an example of the COVID time, so as we entered into the COVID market crash, we were luckily on 12% of the portfolio was in cash. And at that time, of course, once we braced out of the impact of what has happened in the world, and COVID issues were in the headlines, and we realized that, okay, now we have to focus on the portfolio companies that we have and the companies that we always wanted to buy, whether any of these companies have the balance sheet to survive, if at all there is no business for a year or so, or even more than that. And then came the list of companies we wanted to buy. We screened through them and we realized, okay, some of these companies are still going to be good businesses even when the world gets back into its original rhythm. And that's when we realized that, okay, it's good to deploy at least in these companies. We never know when these tide will turn. And as we saw in hindsight, now it's seems obvious, but at that time we didn't know. There was no vaccine, there was no lockdown opening up, there was blanket ban on a lot of things. Work from home was normal, so we didn't know at that time. But of course, we deployed money based on the idea that these companies were good quality companies. They meet all our criteria, and they can withstand the shock of not earning revenues for a while. They will not be in duress if something goes wrong or continues to be wrong for a long period of time. And these companies also bounce back. So it happens. And that time we had 0% cash. But leading into that period, if you see the last rally of mid and small caps that happened somewhere in 2018 December, 2017 December, 2018 Jan, that time we were at 30% cash. So far higher than what we are in terms of percentage. Today we are somewhere close to 22% in cash. So yeah, we are not shying away from having cash. And at that time, let me remind you, the fund was a lot smaller than it is today. So despite that, so it doesn't matter about size of the fund or the opportunity size available, but it depends on the valuations that we are seeing in the market, and we don't want to chase valuations we are not comfortable investing in.
So what I understand is in terms, it is more in the context of scarce opportunities, or when valuations are stretched, you would continue to maintain your cash positions and
Yes.
deploy at the opportune times. That seems fair. And Ronak, you mentioned about, being a complete bottom-up stock picker approach. And that's very, very evident whenever we have looked at your portfolio, when your fact sheets are published. Now, my question is, increasingly we are seeing that the cost of corporate governance lapse is becoming very high and very severe. You also mentioned some examples of ILFS, various other banking entities, which kind of declared bankruptcy during the same period of 2018-19. I'd like to understand that how do you tackle a qualitative factor like this in, kind of continuously tracking your portfolio companies and ensuring, just not that the execution, corporate governance is maintained, but they're also improving over the course of the time. What are the checks and balances you take as a team to ensure that is met?
Yes. So primarily, when you look at management quality, promoter quality, you have to go back in time and see all the published documents that the company has reported over time, preferably 10 years plus. That gives you a good idea of how the company has been operating. And if the promoters have been at the helm as running the company as well, you see their behavior in terms of how the capital was allocated, and that is evident from their behavior in terms of whether investments have happened, are they focused on return on capital. If you see even related party transactions between key management personnel or even the family members of these promoter families, you realize that some of these things are evident and documented over time based on accounting rules. So those are something you can track. Other qualitative checks you can do on the people is how their demeanor is across time, whether in media interactions, whether in so there are some promoters or some business managers who prefer to be on the party circuit as well. So you be aware of that. So you know that this person that has another side to his personality which you may or may not like, or you can correlate that to how the business operates. That is one thing. Secondly, the quality of the business is something very, very important. Can that business allow you to generate profits across multiple cycles? That also you can track over a period of time when you look at the numbers over a long period of time. So qualitative checks come through numbers. They come through your observations about the behavior of people. They come through the way this particular company has been operating compared to its peers. And you can also see the best practices and standards in the same sector of companies which are listed outside. So the advantage of having a global approach also comes in here, where you know that there is a best practice happening somewhere, and you can actually have some benchmark to how they are operating compared to that. And of course, we have to leave some room for error. Not everything is evident when you study it. Despite all the effort you put in, despite all the research you would do, there will be some things which are just unknowable at that time, and you have to grit with it. So, for example, everybody knew the balance sheet of a company like Island FS and the entire group, but nobody knew it was so fragile because it had so many interlinkages to various infrastructure projects and is cascading layers of debt, which you have to be an expert in that sector. So another aspect of governance is also how capital is managed. I mentioned that earlier briefly. But if a company or promoter is reliant too much on the generosity of strangers to raise capital when they require it to run that business, that also is a huge red flag. So if you don't have enough cash flow that the company generates and you cannot deploy that cash flow, and you still need more capital from outside without having good justification of diluting your existing shareholders, without giving good justification of borrowing a lot on the basis of your company's past cash flows, can you justify running that business with so much debt or so much dependence on outside capital? So those things are also very, very evident from the information that we study. So these are summary points, but actually you can go into great detail across all of these points and see that how this particular management team, promoter team, and this business has behaved over a period of time compared to its peers, compared to the industry, compared to some benchmark of what is happening. And that qualitative aspect is also a little bit personal because this is something of a filter that we use. It may not be a filter necessarily for everyone. So if you see the portfolio, we have not had too many cyclical businesses in it. We have not had too many companies who have leveraged balance sheets. We tend to prefer companies who have their own operating cash trajectory and positive operating cash trajectory. We don't penalize companies for having a lower free cash flow because we want them to keep reinvesting and growing that business. But having a consistent operating cash, having a consistent relationship between the operating cash and the net income of the business, some of these things are quantitative and qualitative factors we track across time.
We are in an industry where everyone is about rushing about garnering AUM, and you seem to be one of the exceptions there. Because if I look at one of the unique aspects of your fund house, you have very few products. You don't have any NFOs which come very often. You don't have any presence in passive strategies. Though you started with PMS, you don't have a PMS at the moment. There's not even a fixed income product, so to say, pure fixed income product in your portfolio. Now, for an investor who's looking for a broader range of options across styles, themes, how do you position yourself? What is your pitch to them?
So far we run about 6 schemes in the AMC. You mentioned about PMS. So although we retain the PMS license, we have not raised capital there, or we have not added new investors there. Most of the investors in the beginning, which came to the Flexi Cap Fund, which was the first scheme that we launched, came from the existing PMS clients who were allowed to invest from even taxation point of view in a mutual fund product in India. Most of them were resident Indians, and it was easier for them to invest directly via the PMS and transfer that to the mutual fund. Whereas investors who are abroad, they some of them are still there in the PMS. We have a separate team who runs the PMS in the sponsor company. So in the mutual fund setup, in the AMC setup, the first product we launched was the Flexi Cap Fund, and we had this thought in our mind that this is enough, good enough for anyone. If they want an equity product, all your best ideas should be under one roof. You should have a global diversified approach, and you can take advantage of across market caps, across sectors, whichever best companies you find, you should be able to invest in. It's true to the label Flexi Cap, although the label came in much later when the category rationalized afterwards. But at that time, it was called the Long Term Value Fund, and the principles have been the same of running a Flexi Cap kind of a portfolio. As we grew as an AMC, the first thing that we did, even from the first year, was to communicate very clearly what we wanted to do. And we created this unit holder meeting concept that once in the year, we will address all our investors, no matter where they are. So now we do most of it remotely, but we used to have we still have a physical event once in a year, which is live streamed across the world. But we wanted to do this as an important communication for our investors, where they can ask us questions in a live format or submit their questions in advance. So whatever they want to ask us about our investment style, the same questions that you asked earlier, or even about specific companies, or why we have invested in something, why we did not invest in something, why we bought and sold something during the year, we should be answerable to all our actions. And that's the reason we started the investor meeting. That was one USP for us, where we thought that this communication is very important to keep the investors aligned to how we are thinking and how we want them to behave in the long term manner as well. Another aspect of the fund, when we are uh, looking at these investments, we are not trying to do short term trading. So our behavior also matters. So if you see the portfolio turnover, that also has to reflect the long term orientation. So on an average, the portfolio turnover has been about 20%, sometimes it is even lower. So on an average, it means that we hold our investments for at least 5 years minimum. So that long term orientation also has to come from the portfolio allocation and the behavior we have. Some of these have been distinction factors of the Flexi Cap Fund. But later, as the fund became more and more popular, we realized investors have a demand from us that why don't you also launch a tax saving product like an ELSS fund, which in the old tax regime made a lot more sense. So we launched the ELSS product with a caveat that it cannot invest in global stocks, and it only has up to is compulsory 80% of it has to be invested in domestic stocks at any given point in time. That's another scheme that got added. But if you see the portfolios of both of these schemes, they are broadly the same, minus the global stocks. But the philosophy is going to be the same exactly for the tax saver as well as the Flexi Cap Fund. After that, most of our funds were also being distributed by a lot of partners, and they had a request that why don't you have a liquid fund in your AMC, which will allow us to park money lump sum, which can be invested via systematic transfer plan or STP into your equity schemes, because they had their clients money coming in lump sum basis, and they didn't want it to be kept outside. So that happened with the liquid fund launch, where it was catering to a specific need to invest in our equity schemes. So these 3 schemes came into being. And later on, we found a unique opportunity when the category rationalization happened, that the conservative hybrid category was not being taken advantage of to the full extent that it allowed us to invest. So at that time, before the tax regime changed, conservative hybrid category was allowed to invest in equity, to invest in debt products, in government securities, SDLs, and more interestingly, the REITs and InvITs, the real estate investment trusts and the infrastructure investment trusts. And that combined in one portfolio was a great debt product that one could launch. So we run our conservative hybrid scheme in the debt format, which unfortunately after the tax rationalization happened, we realized that it was not a very efficient vehicle for people who are in the higher tax bracket to invest in the debt product or a hybrid product. So we maybe grudgingly launched two schemes. One was the dynamic asset allocation fund, which mimics the style of the debt investments we do in the conservative hybrid fund. And one more scheme we launched was the arbitrage fund, which basically gives a debt like return with a favorable taxation for investors. So that's the reason we have six schemes. Although the initial idea was to keep the number of schemes as low as possible and make sure that schemes serve a purpose. And also we can differentiate meaningfully based on what we are doing or what we bring to the table, rather than being also ran kind of schemes. But some of the schemes had to be launched because there was a specific investor need and the taxation rules changed, because of which we launched them. So the whole idea was never to create a litany of schemes and ask people to invest in all of them and confuse the investor when they come to our website. It has to be very simple. The messaging has to be very clear, and each scheme has to solve some purpose for the investor. And if we can meaningfully differentiate by bringing our style of investing or our style of stock picking, because PPFAS has been an equity fund house right since the beginning, then that should be the meaningful differentiation in how we manage these products. So you will necessarily see less number of schemes coming from our side. And if in the future, if we find a category where new schemes can be launched, where we can meaningfully differentiate, you will see some new schemes coming up, but only if that criteria is met.
No, this is really helpful. And we totally concur with what you are saying that if you feel that a particular theme can do better, you can always add it in your existing fund. There is no need to launch thematic funds after funds. And at times, it may confuse the investors also. Ronak, till now we have considered the positive aspects of the fund. Now let's try to understand maybe not so positives or the mistakes also. Now, what we've seen since the COVID, at least in the last 4 5 years, is that market cycles seems to be getting shorter and more frequent, and there is a lot of pressure to act or not act. And it's never been like this. Say it was not the situation 10 years back. Now, how do you personally think about managing the errors, be it errors of commission or omission, and which one are harder to avoid? If you could share some examples.
So throughout the history of the fund, there have been both errors on both sides. Errors on commission are more serious because you have thought of something and it has not played out the way you wanted it to play out or way you expected to play out. Errors of omission can be for various reasons. So errors of omission are not just basis on price, but actually missing companies which were qualified to be part of your investment universe, and you hesitated because the price was not right and the price kept on going up eventually. So we are not too we don't beat ourselves too much on those kind of errors where the price was not right when they wanted to buy. You could always buy something later if you think the opportunity still exists and a little bit valuation has gone up, but doesn't matter. You know that the longer term trend is still strong, and you can always participate in small chunks over a period of time in the same opportunity. But the errors of commission hurt a lot more because there you have calculated the odds of something working in your favor and that has not worked out. So to give an example of that, in the earliest days, we used to own this company called Noida Toll Bridge. It used to run, it still runs the tollway between Noida and Delhi. And that toll road was like a bond disguised as a stock, where it had a trailing cash flow, which was known that at a certain point the cash flows will stop from the toll that the company can collect. Whereas the cash requirements of that business was not a lot, so all the money could have been eventually been paid out. And as the traffic volumes kept on increasing, you would get incremental cash flow in the form of dividends from that business, and it becomes a very great dividend yielding stock. That was the hypothesis. Of course, there were risks associated to that the volume may not pick up or things will not work out in the same growth rate that you expect it to happen. But one catastrophic risk that also was part of the thought process that actually played out was the toll being waived off on that particular bridge. That is because of political pressure and the high court case that happened because they thought that toll collection was unfair. Although the bridge was built in the late 90s with the cost of capital of that time, the basically the bridge would have never recovered that cost of capital, and kept on increasing the toll to justify its existence or the cost of capital at that time. So although financially it made a lot more sense, and the numbers it made a lot more sense, this real risk where the agitation of people can actually push a business to get cancelled by even the law, which the paper that they had signed as a contract that they have to enforce for the next 30 years, they did not enforce that and they said this is illegal. They might eventually win in the Supreme Court, but that was a mistake. That was something we decided immediately to get out of when we realized that this is a catastrophic mistake that the business has suffered, and we have to come out of that. And we exited that stock. There were some errors in the past, like Island FS Investment Managers. We invested in a AMC kind of a business, which had a similar business like an AMC, but it had a private equity play to it. It had real estate play to it, and the profits were also in the form of carry that the fund earned. Again, it was affected by cyclicality, and it was a mistake at that time. Companies like Mahesh Tutorials or MT Educare, where we thought that the business was advanced cash collection and then deliver service over a period of time, that changed their business model, changed their balance sheet during our ownership, and essentially became a very different working capital heavy business, which was a mistake to hold in the portfolio. And there will be some companies like, for example, IBM, which I thought as a technology analyst was a great company that could do well because they had a legacy of global consulting IT services and also server products. Server product segment still does okay, but the other consulting part and the global services piece has shriveled over a period of time. So yeah, it was a mistake in terms of the company's fundamentals kept on remaining the same, whereas the market opportunity was shifting to other players and competitors were taking the market share. So some of these mistakes, in hindsight, I can call them as mistakes, but at that time they seemed like very plausible ideas and should have worked, but didn't work out in our favor.
Thank you so much, Ronak, for being so candid with your mistake. It's not easy. And that brings me to my next question. And this question is about the general trend in the world today. If we see, there is a lot, I mean, there's sheer volume of macro signals today, ranging from what is happening with the central banks, currency dynamics, we have trade wars, we have geopolitical situations. Now, it's easy to get caught, reacting to these rather than investing. Now, how do you differentiate between those macro noises which should be ignored and the one which should be acted upon or respected? And how does it play in your day-to-day decision making?
So in day-to-day decision making is useful to be aware of the macro data points, but unfortunately, I don't know if they have any predictive value. So we are forward-looking investors. When we invest in any business, we are looking at the future opportunity that is there in that business or a sector. So of course, there is some forward thinking as to whether this company or a sector can achieve something in the future or not. But it has impact of macro events as well. It's not necessarily disconnected from macro events, but unfortunately, knowing what macro events can affect and how they will actually play out is not something that is very easy to process or even easy to imagine. Many times some trivial thing happens somewhere and that leads to a cascading effect of macro things, and it's like Murphy's law. If something can go wrong, it goes wrong in that particular sector or a business. But the bottom line is that the companies that you invest in have to be solid enough to absorb some of these short term shocks as well. Unless something catastrophic happens, then yeah, we are aware. So for example, COVID was a macro event which you could have modeled a little bit in your thought process, because SARS had happened. You could say, okay, a pandemic like event can happen where Chinese factories were shut at that time, and no, the Southeast Asian economy was shut down for a while. The airplanes were not flying at that time for Southeast Asia. So one could have modeled that as a risk factor, but no one would have predicted the impact, or no one would have been able to give the assessment of what is the range of the impact that can happen. So if it does not have too much of predictive power or predictive ability, it's hard to use as a data point with weightage. But it is also not wise to not know of the macro events happening. So you study them, you little bit worry about them, But while thinking about building a portfolio, you think bottom up and make sure that the businesses you pick have the solid characteristics that you really want in those businesses, and enough balance sheet capacity, even enough management capacity to withstand some of these shocks for a short period of time.
We should be reading them, we should be analyzing them, but we should not making decisions solely on the basis of those.
I mean, we
So,
are not capable of doing that. Maybe there are people who can do it, but unfortunately, we have not been able to do it.
understood. So, Ronak, my last question in this series of questions is understanding today's market, because that's also very, very relevant when we are discussing this with you. Now, if we look at valuations, flows, sentiments, where do you believe we are in the current cycle? Are you cautious, optimistic, or are you aggressive, or are you getting aggressive? So, and are you worried about some excesses which have got built up in certain pockets in the market in last few quarters?
So in fact, the last few years, we are seeing at least the valuations in Indian businesses to be far stretched beyond their longer term median valuations. So there are very few opportunities or few pockets, at least in the domestic market, where valuations are still reasonable, or I would say close to fair. Where in many cases where cyclical growth rate has played out, people have bid up some of these sectors to levels where I don't think one can recover or cannot make sustainable money over a period of time in terms of CAGR, and even a little bit of lapse in the growth rate or a little bit of air pockets if any of these sectors hit, that can actually be catastrophic for the valuations. So if you look at cash flow multiples or earnings multiples of some companies, if you are paying a very, very high multiple in the beginning, one would have to be very sure about the trajectory of the growth of those earnings and cash flows. And if that is not maintained, you can also feel a change in sentiment also of the investors in that particular sector, and that can derate the particular portfolio of a company at that time. So it's very, very important to understand the starting valuation that you enter in. You can use a DCF model, but again, DCF requires a lot of predictive capability as to how well can you predict cash flows. Unfortunately, we don't have those predictive powers, but what we can learn is, can you price a particular security or a stock based on the risk free rate or based on the other alternatives that you have? So cash in this way gives us that kind of a comfort where you understand that if you don't have to invest, then this is the bare minimum you will earn, at least in the cash piece of the portfolio. And the rest of it, you can choose to find opportunities which are close to the pricing range that you want to expect for that growth rate and the risk that you're taking by investing in those sectors. So today, if you see the portfolio, where I say 22% of it is in cash, that means the rest of it is still invested. So we are more invested than we are in cash. So we are not entirely cautious or risk averse, but yeah, we are cautious to that extent that we don't want to deploy money at these valuations across all the companies that we like. And the ones we already like are already in the portfolio, and we keep studying new ideas. We keep adding at the margins if we find something interesting. Like for example, the past few months, you would have seen Bharti Airtel being added at a sizable position in the fund, because that company is something we've been studying for a while, and we felt comfortable that this is a reasonable price to pay, considering the advantages or the operating leverage that the company has in the longer run. And you will see some of these additions strategically being added when we feel the valuations are reasonable. But we are more cautious than we were in the past. Also, the inability to invest additional money in the global piece also restricts us from chasing opportunities there. And the companies we already own over there, we think are fully deployed in terms of what money we can invest in them. In fact, whatever dividends we earn from the global stocks, we continue to reinvest in the same ideas because we think those companies still have a long runway. So we are more cautious than we were in the past. But that doesn't mean that the rest of the portfolio is still invested in equity. So we have to monitor the health of all those sectors and companies as well. And most importantly, keep track that these valuations don't go out of hand.
Now to end this, maybe a few lighter questions in a rapid fire format. One investing principle that you hold sacred even when the markets don't agree.
I think thinking long term is not just about the prices of the stocks, but also the fundamentals of companies. There's one principle I think I hold sacred is have the ability to think long term about any business you look at, not just from the ownership point of view of the stock, but also studying any company which you have not invested in yet. See what are the long term trends that you want. So long term, yeah. Sorry, so rapid fire. I went into a long answer.
Got it. And one financial cliche which you wish would retire forever.
I think only equity is a lot of people have this thought process that you just have to chase returns, and that means equity heavy investments. I think asset class thinking is missing. So maybe that is only equity should not be the mindset. I think it retires before people retire.
And that coming from an equity fund manager, it's very interesting. So Ronak, AI, crypto, green energy, EVs, how much is fad and how much is fundamental?
One of them is fad. All the rest three are fundamental. I would let you choose whichever
Got
you.
got it. And one word to describe the long-term opportunity in the Indian equity market.
I would say positive. Uh, so that is, see, again, as an equity investor, I am more optimistic, but at the same time, I also have to ground myself to what valuations we pay. So although I'm positive, but like I said earlier, cautious and positive at the same time.
Got it. And on with this, we come to the end of our conversation, and it's been really enlightening on a lot of parameters. And I would just summarize with a few key points, which would be takeaway for us. One is that don't be first about your home country or don't have that bias. Good ideas can come from any part of the geography, and you have data point which indicate that over a longer period of time, nothing is consistent. Opportunities can come from anywhere. Not to choose fads and being conscious about the price. Global allocation is not just about taking opportunities and paying lower price, but it's also about tiding over home crisis, which may happen from time to time, like what we saw a couple of months back. Tracking long history of companies this is very interesting for me. That if you track companies over a very very long period of time, if you track the demeanor of the promoter, you get a good idea about the qualitative aspects of the company. If you are dependent on generosity of outsiders to raise money, then it's definitely a big red flag. Errors of commission hurt a lot more than errors of omission. That I totally agree with you. For a forward-looking investors, the day-to-day signals may have an impact different than what we perceive them to be. Maybe we consider them to be 100% impactful, but at the end of the day, the impact could be anywhere from 0 to 100. And you have been more cautious than what you have been in the past. And lastly, for an equity investor, it's good to be positive. With this, we end our podcast. And thank you so much for taking out time. It's been really great interacting with you. And I'm sure our investors would also learn a lot from this.
Thank you for inviting Megha and Harsh. It was a pleasure and great quality of questions. I really enjoyed describing our process to you. Thank you.